Hi, and welcome to Visual Sectors. Now, you're probably tired of this news-driven up and down stock market of 2022. Cut the noise. Follow the money flows. In the next 10 minutes, we will tell you all about how the Fed, banks, and funds really drive the market. Now, be sure to make it to the bonus part to learn how to make money with this data. Let's go. Visual Sectors is a London-based investment data provider. Our data sets predicted the December 2021 high and the June 2022 low. Every day we process millions of data strings to provide you with simple and clear insights. Please subscribe, like, and share this video if you find it helpful. Now, before we dive into the topic, there are three important rules to follow in order to be profitable. Rule number one, there is no silver bullet. Indicators have to be combined for a really winning experience, and they change over time as the economy does. Monetary conditions change, and trading bots learn how to exploit the data. Rule number two, risk management is key. If you keep losing positions and overload them with cash, they will wipe out any profit the market has to offer. Rule number three, risk-reward ratio makes you rich, not the win rate. If your winning trade brings 10 times more money than you lose on a bad trade, you'll be fine, even if you make a good deal 1 time out of 5. The U.S. stock market has been a projection of profits for decades. It's not anymore. Since before COVID, the game changed, and it's all about the amount of available cash. Now, let's see where it can come from. The Fed's real influence. Why is the rate so important? How much input exactly does the balance sheet make? Let's check in with the rate first. Now, here's a chart that shows how the net interest expense changes with the rate hikes. An astonishing 15% of U.S. corporate profits is wiped out every time the Fed raises the rate of interest. Now, this is the Fed balance sheet. In 2022, it came down from almost $9 trillion to $8.5 trillion, and that is only 10% of the recently printed money. It made the market drop 20%. They plan to wipe out another trillion in 2023. Now, does this mean we're going 20% lower from here? Not if they stop. That's when you know the pressure is off. Now, let's see where the support comes from. Bank repos. Banks have an incredible amount of cash on the side. $1.2 trillion is allocated to overnight repos at just 0.05% annual yield. Now, this money is being destroyed by inflation. One day, when the timing is right, it'll go back to the financial system. Banks will give loans, buy bonds, and invest in equities. Treasury input. Now, the U.S. Treasury spends more than it makes. Everyone knows about the budget deficit, but when you invest, you have to be careful about the timing. The planned Treasury reserves level is at around $700 billion. Now, sometimes they spend more and they need to refill the reserves level. Now, for the second year in a row, they spend up to the limits in December. That brings some cash to the financial system and helps the equities, but they have to get the cash back to the reserves in January. In 2022, it led to a 12% downside move, and it's likely to happen again next month. Margin debt. Retail traders, hedge funds, literally everyone is buying more equities on debt. Now, as you can see on this chart, margin debt is decreasing fast. It's close to $650 billion as of early December compared to $950 billion last December. Now, it may seem like a big enough slump, but consider this. A $650 billion margin debt is the pre-COVID absolute record high, and the rates were twice as low. At this rate level, a $400 to $500 billion margin debt seems more appropriate. Buybacks and dividends. Companies investing in their own stocks is the reason S&P 500 is still higher than it was in February 2020. An amazing number of $1.5 trillion from buybacks and dividends within the last 4 quarters held the market relatively steady. Now, this number is not likely to stand in the next 4 quarters. Declining profits and expensive debt are the reasons companies will not be able to maintain the level of support for their own stocks. So now that we've figured out how this multi-trillion-dollar market operates, we can help you time your move perfectly. In the description of this video, you'll see the links to all the official pages with this data. Federal Reserve, Treasury, no commercial links. Now follow the data weekly. Now you know what it means. As soon as you see Fed balance sheet decline, stop. Bank repos go down and the Treasury reserves exceed $700 billion, you'll know it's the time to buy. Let's go through everything once again. Number one, Fed rate hikes of 1% make debt 1.5% more expensive. Avoid companies with significant debt. Number two, Fed balance sheet declines of 1% makes markets go down by that very same 1%. Number three, banks are the trigger. When they start investing the money from repo, you follow them. Number four, Treasury is a risk. When they need to refill reserves, the market goes down. Number five, margin debt is still very high. Keep an eye on the stats and don't get washed away by margin calls. And finally, number six, buybacks and dividends can be a risk looking forward. Make sure the stocks in your portfolio keep the payout ratio at a decent rate. This research was provided by visualsectors.com, and there is plenty more to come. Make sure you subscribe, hit the notification button, and share this video with all your friends. Visual Sectors is developing exclusive new data sets, providing unprecedented win rate. Please check out our Money Flows data set showing the direction of markets, sectors, and all optional stocks.